All right, today we're going to discuss completing the accounting cycle for a merchandising company as opposed to a service type company. So, in other words, we're going to look at adjustments again. Now, the majority of adjustments for a merchandising company are the same as those of a service type company. So, we're still going to have a depreciation adjustment. So, depreciation expense truck debited and accumulated depreciation truck credited. We're still going to have prepaid expense adjustments, so insurance expense debited and prepaid insurance credited. And we're still going to have an adjustment for supplies, so supplies expense debited and supplies credited. Now, for a merchandise company, okay, we have additional adjustments. So you're going to have to learn the debits and credits or memorize the debits and credits for those as well. So a new adjustment, and the one we're going to talk about today, is bad debts. Okay, and another one is accrued revenue and accrued expense adjustments, and the last one is the adjustment for merchandise inventory. Now, the accrued revenue and expense adjustments we're going to discuss in a future lesson, and the adjustment for merchandise inventory we're also going to discuss in a future lesson. Now, what are bad debts? Basically, they're amounts that we don't think we're ever going to collect for whatever reason. Okay, the company may go bankrupt. The business may have trouble generating cash to pay us. But for one reason or another, not all the people we issue credit to are going to pay us. Now, in order to explain bad debts properly, I'm going to have to, or we're going to have to assume that we operate in the perfect world. And in the perfect world, we can see into the future. Now, we know that's not the case, but let's assume that right now. Okay, so let's assume that year one's net income is $100,000, but we can see into the future. Out of that $100,000, $2,000 will never be collected. So really, this net income figure is not very accurate because we know that it's not $100,000, it's $98,000, because out of this $100,000, $2,000 will never be collected. Okay, so we see this, right? Now, if the adjusting entries have to be made at the end of a fiscal period. So how does the accountant know what the bad debts are going to be for next year for the previous year's sales? Okay, payments may or may not be made, right? So in reality, it's impossible to know exactly the amount of bad debts there will be, okay? Because we can't see into the future. And as a result, the accountant has to estimate the bad debts by using past experience as a guide. Now, in our perfect world example, we knew that our bad debts expense would be $2,000 because we know that the cash received in year two from year one sales was going to be short by $2,000. Now, in the real world, the accountant can't see into the future and has to estimate. Now, the adjustment for bad debts is always going to be the same. It's just like all the other adjustments. So in a bad debts adjustment, bad debts expense is debited and allowance for bad debts is credited. Okay? Now, the bad debts expense account has a zero balance throughout the fiscal period. And basically it's opened with an adjusting entry, and then it's going to be reduced to zero with a closing entry. Now, why do we credit allowance for bad debts? Why don't we credit accounts receivable? The answer to that is we don't know which customers are never going to pay us. So we don't know if Mr. Jones is not going to pay us, or we don't know if Mr. Adams is not going to pay us, or Mrs. Smith is not going to pay us. So we don't know who's not going to pay us. Okay? Now, allowance for bad debts is a contra asset account. It's contra to accounts receivable. So it's going to have a debit balance, right? So it's going to look like this on the balance sheet. So you're going to see accounts receivable, and then right under it, allowance for bad debts. So the net realizable value of the accounts receivable in this case is $51,000. 53 minus the 2, we get 51. All right, now, how does the accountant estimate bad debts? Okay, one way is they can take a percentage of net sales. So they just assume that 3% of net sales, so sales minus sales returns and allowances minus sales discounts, and take 3% of that, and they get their estimate for bad debts. The other way is to prepare what's called an accounts receivable age analysis. Now, in order to do that, okay, let's go over here, okay? So basically what they do is they list all their customers or all their debtors and how much of those debtors owe them and how long that amount has been overdue or due. So Baldwin has $400 in current accounts receivable, so it's not overdue at all. Colillo has $50, okay, in current accounts receivable, $30 that is 1 to 30 days overdue, and $20 that's 31 to 60 days overdue. So a total of $100, right? Now Dobie has $1,000 that's 61 to 90 days overdue. So basically the accountant does this with every account that they have, and they'll come up with total. So the current accounts receivable is $800. Okay, $180 is 1 to 30 days overdue. Okay, 220 is overdue 31 to 60 days. Now, the longer something is overdue, the greater the likelihood that the person's never going to pay that amount. Okay, so what they do is with these final totals, they come up with a second table. Okay, so they place the amounts down and they assign percentages. Now, the more something's overdue, okay, the greater the likelihood it's never going to be collected. So you'll notice that for the amounts that are greater than 90 days overdue, the accountant feels that 50% of that amount, so 150 of this 300, will never be collected. Okay, out of the current accounts receivable, they think only 1% will never be collected. All right. Now I'm going to stop there, and I'm going to create a second video.